Hey everybody, Eric here. So I had a few questions for smaller accounts. How can they best approach trading the naked short put? Which is a really good question. So I did a quick write up on it. Let's hop over to the main screen and let's explore. So first, what is a surrogate naked short put? What is it? Essentially, it's a really wide credit spread that we use simply for buying power reduction. So, excuse me, a lot of times when we trade something like the naked short put requires, whatever margin requirement your broker has, typically can be a lot depending on the size of the product. So we can spread it off. When we trade vertical spreads, a lot of times it's a risk management tool. In this scenario, it's not. We only add the wing for buying power reduction. It's a stark contrast. Otherwise, we're going to trade the same way we would the naked short put. So, like I say on here, the naked short put's one of my favorite strategies. But we can use an out of the money long put that's far out of the money to reduce our margin requirement. And then otherwise, just like the short put. So, for example, when I wrote this out, XLF was at 23.30. So I was looking at the 1 July 22 put at 59 cents. To cash secure the position, it's 2,200 bucks, which is 2.7% return on capital in 37 days. Good money. Um, but 2,200 bucks. So let's take a look at a similar trade, slightly different. We could buy to open that same 22 put, but now let's add the 15 put that's trading for 4 cents. And then notice the margin difference. We go from $2,200 to $645. So this is what adding a far out of the money wing or, spread can do. So a few notes when we're looking to add that, far out of the money leg, I typically am looking for something that's, somewhere from a dime to a nickel, meaning that I'm only going to give up 10 cents or 5 cents for the long because again, it is purely for buying power reduction. It is not going to help save us from a down move. The down move is going to hurt just like anything else, and we're going to have to manage it just like the naked short put with rolling and scaling in, scaling out, that kind of stuff. But the far out of the money allows smaller accounts to trade the strategy, um, even though again it's a smaller account that would otherwise be limited. Now, in terms of underlying selection, stuff like that, all of it is the same as the naked short put. So I'll link to that video in the description for those that are kind of just jumping in on this one but missed the background. But otherwise, that's all there is to it. It's really nothing too complex. It is a little bit more aggressive for smaller accounts, I would say, because even though it has a lower margin requirement, it can still hurt. So it's important to trade products that are a good size for you. For example, I wouldn't necessarily recommend trading the surrogate naked short put in Amazon or Boeing, something that's really expensive, because you're going to have to open that wing up really far and expose yourself to too much risk. For smaller accounts, again, depending on the size, I would be looking, again, that's why I picked XLF. It's $23, not going to hurt too bad, that kind of thing. So I would pick a product that's the appropriate size for your account, but still be looking at index ETFs and still be looking at underlyings within the S&P 500 as I typically would for the naked short put. So if there's any questions, as always, just let me know. Otherwise, I'll talk to everyone later.